Why understanding your paycheck matters. Let's be honest. Most people see their paycheck, smile if the number looks good, and move on. But here's the truth. If you don't understand your paycheck, you don't understand your money. Every payslip, whether weekly, bi-weekly, or monthly, tells a detailed story about your income, taxes, benefits, and financial choices. It's more than just a number deposited in your bank account. It reflects how much you're really earning and how much is being taken away before you even see it. So if you've ever thought, why is my take-home pay so low? What are all these deductions? Where is my money actually going? This video is for you. Because the more you understand your paycheck, the more control you gain over your financial life, from budgeting to saving to optimizing how much you actually keep. Let's break it all down. Every paycheck starts with two key numbers: gross pay and net pay. Gross pay is your total earnings before any taxes or deductions. It includes your base salary, overtime, bonuses, commissions, anything you earned during the pay period. If your annual salary is $60,000 and you're paid monthly, your gross monthly pay is $5,000. Net pay, on the other hand, is what actually lands in your bank account. It's often called take-home pay, and it's what's left after taxes, retirement contributions, insurance premiums, and other deductions are subtracted. This is where most people are shocked. Your gross pay might look healthy, but your net pay could be 25 to 35% lower, or even more depending on your location and benefits. Understanding the gap between gross and net pay is the first step in decoding your financial reality. Next, let's talk about what eats the biggest chunk of your paycheck: income taxes. In almost every country, a portion of your income goes to the government. This money funds roads, schools, public services, and social programs. Taxes are usually withheld automatically by your employer. That means you don't pay them manually. They're deducted before your paycheck even reaches you. There are often multiple levels of income tax: a national or federal tax based on your income bracket, a regional, state, or provincial tax adding on, sometimes even city or local taxes. Here's an example. Let's say you earn $5,000 gross in a month. Your income tax rate is 20%. That's $1,000 withheld before anything else is touched. Now you're left with $4,000, and that's before other deductions kick in. Also important, income taxes are often progressive. That means the more you earn, the higher the percentage you pay on the higher portions of your income. The first $10,000 may be taxed at 10%, the next $30,000 at 20%, and so on. This is why understanding tax brackets is crucial. It helps you forecast your earnings and plan smarter. Aside from income taxes, your paycheck also contributes to social programs, even if they're not labeled that way. These deductions often include retirement pensions or Social Security contributions, public health care or medical insurance programs, unemployment insurance, or disability coverage. These vary widely from country to country, but in many places they're mandatory and automatically deducted from your pay. For example, you might pay 6.2% towards Social Security and another 1.45% for public health care. So from that $5,000 paycheck, another $375 to $400 could go into these programs. Now you're down to around $3,600 net. You may not think about these contributions much, but they're important. They help build your future safety net, and in many systems, your employer also contributes a matching amount on your behalf. Understanding these line items isn't just about knowing where your money goes, it's about seeing how you're building long-term security, even if it feels like a deduction today. This is where things get tricky. While national income tax is fairly standard across the board, regional taxes, like state, provincial, or local taxes, can vary dramatically depending on where you live. Some regions don't charge any state income tax at all. Others may take another 5 to 10% of your income. Let's break it down with an example. Two people earning $60,000 annually. One lives in a region with no local tax. The other lives where there's a 6% regional tax. Their gross pay is the same, but after deductions, the second person could be taking home $3,000 to $4,000 less per year, just because of geography. It's not just income taxes either. Some areas apply local payroll taxes, commuter taxes, or mandatory local contributions. This is why moving from one region to another can affect your take-home pay more than you expect. The key takeaway? When evaluating job offers or budgeting your income, don't just look at the salary. Always ask, what will my net income be after all local deductions? Now, let's dive into pre-tax deductions. These are amounts taken from your paycheck before taxes are calculated.
Why does this matter? Because pre-tax deductions reduce your taxable income. That means you'll pay less in taxes overall, and more of your money is going towards something useful. Common pre-tax deductions include retirement contributions like 401k, 403b, or pension plans, health insurance premiums, health savings accounts, HSA, or flexible spending accounts, FSA, commuter benefits, or dependent care. Let's say you earn $5,000 gross per month. You contribute $500 to a retirement plan and $300 to health insurance. Your taxable income now drops to $4,200, and taxes are calculated on that amount instead of the full $5,000. This is how smart employees legally reduce their tax burden while investing in their future. The more you understand these benefits, the better you can take advantage of them. You're not just spending, you're reallocating your income in a way that works harder for you. Now let's look at post-tax deductions. Money taken out of your paycheck after taxes have already been calculated and withheld. These are usually voluntary and might include union dues, charity contributions, loan repayments, garnishments, court-ordered deductions, after-tax retirement contributions, life or disability insurance premiums. These don't reduce your taxable income, but they're still important to understand because they affect your net pay. For example, if you've got $300 coming out for post-tax items and you didn't plan for it, you may wonder why your take-home feels so small. Always review what post-tax deductions you've agreed to and whether they're still necessary. Now that we've broken down the individual elements, let's look at how this all comes together on a typical pay stub. A pay stub, also called a payslip, is a breakdown of your gross income, all deductions, taxes, benefits, etc., your net pay, the final amount you actually receive. Here's what a typical layout looks like. Earnings, regular pay, overtime, bonuses or commissions, any other taxable compensation, pre-tax deductions, retirement, healthcare, etc. Before tax calculation, tax withholdings, national or federal income tax, state, provincial, local income tax, social insurance or public programs, post-tax deductions, union dues, garnishments, charitable donations, etc. Net pay. This is your actual take-home money, your real income, adding info. You might also see year-to-date YTD figures, helpful to track how much you've earned and paid in taxes over the year. Employer contributions, things like retirement matches or healthcare paid on your behalf. Understanding every line on your pay stub helps you catch errors, understand your compensation, and have more informed conversations about your salary. Even though employers use automated systems, mistakes still happen. And if you don't understand your paycheck, you won't catch them. Here are a few common errors to look out for. Incorrect hours or overtime not calculated, especially if you're hourly or working variable shifts. Wrong tax withholding. You might be overpaying or underpaying, especially if your personal info, like dependents, isn't updated. Missing or incorrect benefits deductions. For example, being charged for insurance you didn't enroll in. Unclaimed reimbursements, like travel or work from home expenses you're entitled to. Incorrect net pay. Compare gross minus all deductions and confirm the net amount is accurate. If something feels off, ask. Contact payroll or HR immediately. Don't assume the system is perfect. You work hard for your money. It's your right to ensure you're being paid fairly and correctly. Finally, let's talk about what really matters. How can you take home more of your paycheck? Here are a few smart strategies. Review your tax withholding. If you're constantly getting large refunds, you may be overpaying tax during the year. Adjust your tax form so more stays in your pocket each month. Maximize pre-tax contributions. Retirement plans, HSAs, or commuter benefits reduce taxable income. You pay less tax and save more. Choose benefits wisely. Don't opt into insurance or programs you don't need. Review benefit elections annually. Don't let old choices drain new paychecks. Track deductions. Know what you're paying for and why. If something's unclear or outdated, remove it. Consider location. Taxes vary by region. In some countries and cities, relocating can increase your net pay significantly without changing your salary. Negotiate smarter. When you get a raise or new job, look at total compensation, not just base pay. Ask about bonuses, employer contributions, insurance coverage. It all adds up. Remember, the goal isn't just to earn more, it's to keep more. So now, next time you get paid, don't just glance at the number. Dig into the details. Know where your money goes. Understand your paycheck line by line. Because financial literacy doesn't start with investing or entrepreneurship. It starts with understanding your income. If you found this video helpful, consider hitting subscribe. I make more content that helps you take control of your financial life, one smart decision at a time. Until next time, stay aware, stay prepared, and let your money work as hard as you do.